Silver is likely in the next, starting with December, it's month 1, 2, 3, you get it somewhere in the second quarter, thereabouts. I'm expecting silver to be at very high price levels. At least 200, probably more like 300 to 500. Okay. Now,
second quarter of this year?
Yeah. In other words, the verticality's only begun. Okay. And again, that would merely be replicating what that copper chart did, or what a lead chart did, et cetera. So you want to be there. And the spread just broke out over a multi-year ceiling. So it's just begun in terms of that relative performance signal. I think what's happening in silver is different than what's going to happen in gold. I think silver is in a major process of decades of catching up to gold in terms of valuation. We're in a bull trend on silver. Everybody sees it. When you look at daily charts of this, you get spooked, like, oh, I got to take profits. This can't keep going, which is stand back and look at a bigger picture, and you should get a different view. But in that 50-year, half a century range of price, you went from $4 to 50 to $4 to 50. So you get a $45 range, okay, roughly. Mm-hmm. And if you do the simple arithmetic silliness of measuring the dimension of the range and say, well, I'll add that to the top of the range, that says, hey, you're in a target area right now. It's $45 range, add 45 to 50, and you end up with something in the mid-90s. Let's call it short of 100. Okay. So people looking at that think, oh, well, this got to be the end of the move. But when you look at silver instead of on this arithmetic or point scale, dollar scale chart, and you put it on a logarithmic scale, ratio scale, going back, again to the 1970s, let's say, and you take the dimension of that range from those, $4 lows to $50 highs, that's a 10-fold move from range bottom to range top, range bottom to range top. 10-fold. Okay. Apply 10-fold to $50 to match the dimension of that range as a swing objective. You're talking $500.
Yep, okay. North of 500.
Yeah, and a lot of people know that, Eric Sprott, for example, I've heard him explain that, if you just do a money analysis of silver price using M2 as your measure of degradation of the buying power of the dollar, silver should be a couple $100 easily. And maybe even higher if you go against the 1980 high. Yeah, you can see what I mean? Yeah, there you go. It's just underpriced, and it's like copper, like lead did in 2006-07, a couple years after that copper chart went crazy. It went vertical in several quarters. It didn't arm wrestle its way higher, exploded.
Michael Oliver predicts silver will reach $300 to $500 by Q2 2026, April to June, representing a 3 to 5 times gain in just 3 to 5 months. The silver to gold spread broke a multi-year ceiling in November 2025, starting a countdown clock identical to the 1979 to 80 and 2010 to 11 explosive rallies. Silver is replicating copper's pattern, stuck in a 50-year range, then vertical explosion in 2 quarters.
Well, how come silver, during all this time you're looking at here, was contained within its half-century box? It's like copper, if it were still at $1.50, all the way over to the right of your screen, it'd be like, well, why is it still down there? Okay, why is silver still down there? Gold isn't. If you look at where it peaked in 1980, we blew that out in 2011, big time. Now we've blown out that high big time. And yet silver only just recently has taken out its 50-year range. I'm not going to get involved in the rationale why that may have occurred, but it was an error. Markets make mistakes. They're not rational all the time. And in the case of silver, it's been irrational in terms of being suppressed too long at an unreal price level. Copper, for example, also this is true with lead, a very exciting metal. They were stuck in a range for multiple decades back in the 80s, 70s, 80s, 90s, 2000, and in 2005 there, you can see there's a cluster of 2004 and 5 But it was later in 2005 that you burst through the top of that basically $1.50 peak that had prevailed for decades. And in a matter, these are monthly, right? Monthly candles. Yeah.
Yep.
So in a matter of a couple of quarters, you went up to over $4. Bam. Okay. Yep. And by the way, it did it on its own. If you look, for example, at another base metal like lead, it didn't do that then. It did it a couple years later, the same thing in lead. And this wasn't associated, for example, with a silver gold explosion of that nature either. This was copper on its own. It just said, hey, I'm out of here. That old reality is not true anymore. I'm underpriced. And in order to get to maybe a more proper pricing, fit with the new realities of copper, let's say, it didn't do it incrementally. If you weren't there, you missed it. Bam, gone. Okay. And then you lived, you'll see, oh yeah, it was a big sell-off after that. But look at the range that prevailed after that for decades. You know, either side of $3, let's say. So a new reality. Silver's in that position now. I think silver's like a surfer on the waves, but everybody's focused right now on the supply demand of the industrial aspect of silver. And they're not so much focused on it as a monetary metal, you know, failing to recognize the history that just the same as gold, it's been money for man going back thousands of years, and at much higher valuations. So, you know, if, for instance, if silver breaks out of the price range that it had for 50 years, which it's now done, why shouldn't silver's relationship to gold as a percent of its price, let's say, divide an ounce of silver and an ounce of gold, which is now like 2%. It was 1% early this year, by the way, ounce of silver into gold. But if you go back to the 79-80 bull trend in silver, or the 2010-11 latter part of that bull trend, silver to gold was over 3% in 2011 of an ounce of gold. And it was up 6.5% of an ounce of gold back in the 1980 period. So what if this time, not only does price go up and challenge the highs of the prior decades and take them out, which it's already done, and maybe do the multiple gain we talked about in terms of ratio scale, why shouldn't the spread go up and at least challenge, or perhaps even take out those dual highs of the past 50 years? So that alone is a monstrous gain. You know, if gold, and by the way, these surges in silver to gold always occur when both metals are going up strongly.
Yep.
It's never the case that silver goes up and gold goes down, for example.
Yeah, silver would have to 3.5x according to this chart to get back to the 1980s high, and that's assuming gold stays constant.
Yeah, and that's the ridiculous assumption. Yeah. We pointed out many times, and a lot of people have quoted me saying that's my target. It's not. But gold, prior bull markets, the last 50 years have been 8-fold gains from bear market low to bull market high. 1976, corrective low just above 100, 850 by 1980. Then over a more protracted period of time from 2001 to 2011, 8-fold gain in silver, bear low to bull high. Our bear low was 1,050. I mean, we'd have to be $8,500 just to do the same thing again that we've done twice before. It's like ho-hum. Gold did it again. You know, 8,500. Well, if you take 8,500 and figure out what 3+% of that is, or 6.5% of that, your jaw will drop. And I'm not sure at all. In fact, I don't think it will. I don't think gold's going to produce.
What was it, 3.5%? 3.5%, is that what you said?
Yeah, 3.5% of 8,500. You tell me what it is.
$300 silver.
Yeah, okay. And then, 6.5%, back in the 70s and 80s. So
yeah, like 500.
Okay, you get the point. Okay. Yeah. Meaning the logarithmic scale swing objective of silver, instead of the $45 dimension, is a 10-fold dimension. Mm-hmm. That sort of fits with the assumption that, hey, maybe these spreads are going to actually challenge or take out the highs we've seen.
Current price at $94 is dirt cheap on a logarithmic scale. 10 times dimension from $50 equals $500 target. Gold miners are breaking out after 17 years of underperformance. targeting a double in relative value. Silver miners are poised for 10 times plus gains as they catch up. A midpoint stumble is expected, but the move beyond it could be even more explosive. The clock started December 2025 window, closes by summer 2026.
The reason silver, first off, back in June, silver approached for the third time dual ceilings it had at $35. In late 2023 and March of 2020, late 24, early 25, silver peaked just above $35 twice. So, quote, a double top, right? Okay. Mm-hmm. And then it got bagged down into April, then turned up again. And by June, it was headed back toward that $35 potential triple top breakout. Okay. If you're a price guy. Momentum said when it went up above 34 and even approached 35, you're gone. You're going to explode. And sure enough, we did. And we argued then that based on silver's momentum of its price, it was going into an acceleration phase. It didn't take long to get back to 50. Okay. But then something else happened. And it wasn't silver being in a bull trend. Silver's been in a bull trend for a while, just like in 79 to 80 when it exploded in the final months of that move. It had already been in a bull trend for a while. Mm-hmm. Same in 2011 when it exploded to 50. It had already been in a bull trend for years. Something happened late in that move that caused the explosive phase. And what it was the our spread relationship versus gold. In each case, I think it was summer of 79, well before that explosion to 50. And in September of 2010, before it launched, it was in the $20 range and shot up to 50. The spread of silver versus gold broke through a ceiling. You plot the monthly close of silver divided into gold and just plot that chart every month. And what you'd end up with, there was a technical ceiling on the spread. We've had it in our reports many times. And it broke out above it. And when it did, that's when the whoosh occurred. And in each of those cases, just like in that copper explosion we showed, the move came and went in a couple quarters. I'm not going to get specific, 5 months, 7 months, maybe 8. Okay. But let's call it at least a couple quarters, but very rapidly. Well, our breakout occurred in November. Okay. The clock started therefore in December. If you ballpark it and say, okay, silver's going to go berserk versus gold and in price for the next couple quarters. So let's say sometime mid-year this year, silver will probably have done much of what it's going to do. And that doesn't mean when it's over, you collapse. No, just go to it, get to its new reality. Mm-hmm. The spread says so. The history of those prior, I use the XAU index, Philadelphia Gold and Silver Miners Index. It's been in existence since the 1980s. And if you went, what I've done on this chart is we plot every single month's close, divide XAU price into the price of an ounce of gold. And even further than I show there, this chart starts in the year 2000. But you could go back 20 plus years there and you'd still see that it lived in a performance range with the value of XAU ranged either side of, actually it got over 35% back in the prior to 2000, but it lived around 25% for a couple decades, several decades. Mm-hmm. Right now, the spread reading last weekend was 8.54%, meaning divide XAU into gold using the February gold futures contract now. If you get to 8.62 decimals above where we are now, you blow out the top of that range. Okay. I expect you're going to do it. But when you do, and if you look back at this chart, even going back into the 1980s, there is zero resistance to any upturn on this basing pattern when it breaks out till you get to about 17.5%. Yeah, so meaning, that rally high and also the lows that preceded for the prior decades, which you don't see here. You see one of them. It's 17% there. But you can double, you can double the relative performance of gold miners to gold in a whoosh because there is no resistance until you get up to that median, actually low level relative performance level. 17% or 18%. There's a whoosh effect. Now, in each of those cases, we microanalyzed those final surges, 79 to 80, September 2010, April 2011, where silver went up double and a half or quadrupled, et cetera. In the middle of those moves, roughly, on the clock now, middle of the clock of those couple quarter moves, there was what you could call a correction or a stumble, or at least a pause. In 79, prior to getting to the January 1980 high, there was not a reversal on a monthly price chart, but there was a pause such that you wasted like 6 weeks in that final surge. You see the little red candle you got there on the monthly?
Yep.
No, the one before you get to the top. That one. No,
this one?
That little guy. Yeah. Okay, so you can see that in October, November, December, there was some lateral action in each of those months where you could have bought and sold it at the same price, meaning there was a pause in the middle of that explosion, which obviously the candle before that was a huge up green candle. And it was followed by what? Another explosion. Similar thing happened in 2010 and 11, if you can move over to that. Again, that's the kind of pause that will confuse people because they'll think, oh, that's the top. Okay, go to 2010 and 11. Okay, there. Oh, see that red candle there? That was a reversal month. In fact, the intra-month high that month was higher than the prior month, and you closed down. So technicians would say, oh, that was a key reversal month, right? Okay. It didn't follow through at all the next month, and it blew your head off. Okay. So again, about in the middle of the clock of that couple quarter explosion, there was a stumble point that no doubt will fool people. So I'm betting probably sometime either late this quarter or early next, there could be a stumble in silver at much higher levels, perhaps, that creates that sense of, oh God, it's over. False sense. Anyway.
So in this case, silver closed out at around $28 on this reversal month, but ended up closing out the cycle at around $50. So almost a 2x from that reversal. Yeah. What was the high to low for this one here? Do you know off the top of your head?
That was not even a down month.
Yeah, 16.
It was just a pause, but you could see what preceded in 2 months prior. Yeah. You went from $8-9 to 15. You doubled. You had a stumble month, and then you went from what was that, about $17-18 to 50.